Hello and welcome to the Business Standard Morning Show. I'm Nazia Iqbal. It's the 11th of December 2023 and here are the questions we will be answering today. Is the North-South divide real? What will higher cash outgo mean for government finances? What will keep the markets busy this week? And what is the interim budget? The state poll results that came out on 3rd of December reignited an old debate, one around the country's regional divide. Remarks by a few politicians from southern states, which were later slammed by both the BJP and the Congress, once again trained light on North versus South divide. So how different are these two regions economically? Is this divide for real? Kasturi Akhil dwells into data and talks to experts to find out.
While BJP celebrated an impressive victory in Hindi heartland, its complete absence from South India gave opposition parties a handle to take a jibe at the Saffron Party. While some of the comments triggered a row and was slammed by both the BJP and the Congress, they brought back focus on the North-South divide. And it is not just the political galleries. This divide has been finding echo in various quarters from time to time. The central government's decision to use the 2011 census for the 15th Finance Commission was slammed by the southern states, which alleged that they were punished for controlling population. Earlier commissions had used the 1971 census as a base. So how deep is this North-South divide? South Indian states were clearly successful in arresting the population growth between 1971 till the year 2011. When the last census was done. A look at the chart suggests that Kerala and Tamil Nadu are at the bottom of the pyramid, while Rajasthan, Haryana, Bihar, MP and UP are at the top of the population growth chart, and population explosion has its own implications. A median child born in the south will have a better chance of survival. Madhya Pradesh and Uttar Pradesh have the highest infant mortality rate, while Kerala and Tamil Nadu are at the bottom. Citing data from the Reserve Bank of India and economic surveys of the states, a leading financial magazine reported earlier this year that the 5 South Indian states, namely Andhra Pradesh, Kerala, Karnataka, Tamil Nadu and Telangana, constitute over 30% share of India's GDP. In FY23, Tamil Nadu, with a GSDP of 23.6 trillion rupees at current prices, takes the top spot. The numbers for two big states, Gujarat and Maharashtra, were not available for the period. UP came next at 22.57, followed by Karnataka at 22.4 trillion rupees, Telangana at 13.3 trillion rupees and Andhra Pradesh at 13.2 trillion rupees. Speaking of per capita income, India's per capita income has grown at a compound annual growth rate or CAGR of 9.3% in the last decade. 10 major states have outpaced it, with 5 belonging to the southern part of the Indian subcontinent. Karnataka tops the list with a 10-year CAGR of 14.7%, followed by Telangana in the second position. The South Indian states have largely eliminated extreme poverty and have medium to high human development indicators. According to Niti Aayog's latest National Multidimensional Poverty Index, Kerala emerged as the least poor state in the country, followed by Tamil Nadu in the 3rd place. Telangana on the 8th, Andhra Pradesh 9th and Karnataka on the 11th position. So going by these indicators, broadly, South Indian states present a healthier picture than their North counterparts. What could have led to such a clear divide?
The point is by 1992, once we had the liberalization process going, the idea of regional disparities was taken out of the equation. Nobody spoke about it, as a result of which capital went into centers that were already well developed. Right? And most of these centers were in the West and the South. Right? At the same time, you had aspects of pressure on agriculture occurring all over the country, but in the North and the East, that pressure could not be absorbed locally, by and large. Right? As a result of which they were forced into migration. But since the cities that had emerged were were really expensive, there was no permanent migration. So they were really into short-term migration and then went back into their villages. That's the fundamental divide which you're seeing in HDI in every other element.
A look at the RBI data on average daily wages shows that Kerala, Tamil Nadu, Andhra Pradesh and Karnataka had higher average daily wages than the national average in rural India in the construction and agriculture sectors. Kerala was on the top of both the lists.
The wage in South tends to be higher than the wage in the North. And of course, there is migration of labor, but it's actually very small considering the huge gap in the wage between the North and the South. So that raises the question of why don't more people migrate down South? Now, of course, there are issues of language, culture, etc. But there's also an issue of availability of jobs. So it is true that the wage is higher in the South, but if a whole lot of workers were to go, then there aren't so many jobs available. And if there is rationing of jobs, then obviously the people from the South would get the jobs in whatever way, explicit or implicit, and the migrants from the North will not get it. So one has to keep that in mind.
A deeper analysis of election results suggests that India is not so regionally straitjacketed. Congress scored more overall votes than BJP in MP, Rajasthan, Chhattisgarh and Telangana. In the 5 states, the BJP's total number of votes were 4.81 crore, while Congress got 4.92 crore votes. But yes, data shows that southern Indian states continue to outperform the rest of the country on several parameters like health and education.
Clearly, some North Indian states have a lot to catch up. Meanwhile, it looks like the government is trying to catch up with the increasing spending, especially on subsidies. It has now sought Parliament's approval for additional spending of 1.29 trillion rupees. So what does this extra cash outgo mean for government finances? Abhijit Kumar finds out. In the first batch of supplementary demands for grants for FY24, the Union Finance Ministry has requested the Parliament's approval for an additional gross spending of almost 1.29 trillion rupees. This spending involves a net cash outgo of 58,378 crore rupees in FY24, while the rest will be used from the almost 71,000 crore rupees of savings and receipts of the government coffers. In the first supplementary demands for grants in FY23, the government had sought approval for gross additional expenditure of nearly 4.36 trillion rupees, with a net cash outgo of 3.25 trillion rupees. However, in FY22, despite the grants being higher than this fiscal, the net cash outgo was much lower, at 23,674 crore rupees. The higher cash outgo for FY24 as compared to FY22 can be attributed to the increase in the food and fertilizer subsidy bill. The Finance Ministry has said that the additional expenditure on rural employment scheme and public sector companies will be met through the savings and receipts and recoveries. The additional spending demands, which will be met through the net cash outgo, are primarily for fertilizer, which will be 13,351 crore rupees, food subsidies at 10,396 crore rupees, the Guarantee Redemption Fund at 9,014 crore rupees, and defence spending at 5,626 crore rupees. The document presented in the Lok Sabha showed that more funds for the Rural Employment Guarantee Scheme will be met through savings, recovery and receipts. The recapitalization of regional rural banks and fund infusion in various public sector insurance companies, as well as LPG subsidies, will also be met through the savings and receipts. In the FY24 budget, the government had set a fiscal deficit target of 5.9% of GDP, aiming to bring it down from 6.9% in FY23. During the first 7 months of the financial year, the government had used only 45% of its fiscal deficit target of 17.9 trillion rupees. So, will this additional spending affect the government's fiscal deficit target plans?
The impact of additional supplementary demands on the overall public finances would be minimal, for a simple reason that the last budget's assessment on that overall revenues as well as the tax base in terms of nominal GDP growth appears to be lower than what actually it could be. So the recent trends in both nominal GDP growth as well as the tax mobilization suggest that the additional demand for grants can be covered by that excess revenue that government may mobilize due to widening of tax base. And also one more thing is that it appears that even the tax buoyancy also would be much higher than what they assumed in the union budget for the current year.
With the GDP growing at 7.7% in April to September, the first half of FY24, the government is confident of meeting the fiscal deficit target with robust tax collections. Economists believe that due to better tax collections, the impact of this additional spending can be easily contained. Till October 2023, the net tax revenue stood at 13 trillion rupees, which was 55.9% of the total budget estimate. The total non-tax revenue was 2.6 trillion rupees, which is more than 88% of the budget estimate for the full fiscal year. But will the supplementary demand squeeze the government finances?
Our view is that expenditure overall is going to be within the budgeted level. And on the revenue side, there are many positives and negatives. The positives are that the dividend transfer from the RBI is higher than budgeted. Direct tax revenues are likely to be higher than budgeted. Negatives are customs duty, excise duty, and disinvestment are likely to fall short of the budget estimate. So, on balance, we feel that the receipt side is actually balanced. And that's what we feel for the expenditure side as well right now. On CapEx, specifically, there is actually a huge headroom for spending to be completed in H2. And that is something that we feel would be difficult if the Model Code of Conduct is announced sometime in the next quarter. And therefore, we don't think that there is a material risk of the fiscal deficit being breached in absolute terms in FY24, in spite of the fact that we strongly feel that GDP growth is going to slow down.
Economists believe that the government's proposal to seek additional spending is unlikely to have major implications on its finances and future plans. But they caution that the robust GDP growth witnessed in the first half of FY24 may not sustain in the second half, mainly due to the upcoming 2024 general elections, global slowdown, and dilution of pent-up demand. With the push for fertilizer subsidies, fertilizer stocks have jumped about 7% last week after the government submitted supplementary demand for grants. Moving on, December has been a bumper month for domestic equity markets so far, with the Nifty index crossing 21,000 on Friday and the Sensex eyeing the 70,000 level. As we enter a busy week, which factors are likely to influence the market direction and what do technical charts suggest? Harshita Singh and Rex Kano explain in this report.
The Reserve Bank of India's status quo on key benchmark rate on Friday sent the Nifty 50 past the 21,000 level, making this its new lifetime high. This feat was achieved in just 3 months after the index touched 20,000 for the first time on September 11. Dalal Street now starts the week with a busy economic calendar, which would decide the market trajectory. Among key events, India's November CPI, due on Tuesday, December 12, will be crucial. The RBI governor has predicted the CPI print to be higher for the last month. A Reuters poll expects this to have risen to 5.7% from 4.87% in October due to an uptick in food prices. Retail inflation in the US will also be kept an eye on Tuesday. while the Federal Reserve's monetary policy outcome on Wednesday could be another market-moving event. Later in the week, wholesale inflation in India and the US, the European Central Bank's rate decision, and domestic trade data will be closely monitored. On the global front, the US Federal Reserve is widely anticipated to continue with a pause. Bond markets are pricing a 97.7% chance that the Fed funds rate range will be kept steady at 5.25% to 5.5%. Investors, however, will primarily look for cues on how early the Fed could begin rate cuts in 2024.
In US, the initial jobless claims are currently at 220,000 levels. It makes definitely FOMC to keep the key interest rates at a status quo, and the guidance from FOMC is extremely crucial for the global markets in the near future. But we expect the FOMC to maintain a status quo.
In case of a more than expected hawkish Fed commentary, domestic equities risk facing some weakness after their sharp rally of around 6% in the past 2 weeks. Analysts, however, say that any likely dips should be bought.
What we can see is a continuous support from the domestic institutional investors, and also legion of retail investors have been keep on participating in Indian markets. Definitely, markets are positioned to go up and sustain at the higher levels, and any dip in Indian markets is definitely as a buying opportunity for the investors.
That said, on technical charts, the BSE Sensex and NSE Nifty are looking at resistance levels of 70,350 and 21,100 respectively, above which the next hurdles are at 71,000 and 21,350. In case of a downturn, the benchmark indices could dip to 68,350 and 20,550. Today, on December 11, stock-specific action and global market sentiment will guide Dalal Street trajectory.
He's making plans for an early retirement. Business Standard.
Financial markets keenly await presentation of the Union Budget. But being an election year, the budget, which will be tabled on February 1st next year, will be interim. And Finance Minister Nirmala Sitharaman has said that it won't have any spectacular announcement. But what is an interim budget? Tariq Ahmed decodes it. An interim budget is like a temporary financial plan that the government puts together when there's a change on the horizon, such as fresh elections. It's a bit like a placeholder budget to keep things running smoothly until the new government can make a full-fledged budget for the whole year. So, the current government, just before stepping down, makes a quick plan on how to spend and save money for the next few months. In India's case, a new government will be formed by July next year, and the interim budget will put together the projections from March to July 2024. It focuses on the most important things like paying people's salaries, pensions, and keeping ongoing projects going. It's not the time to start new policies or change how taxes work, but just a simple plan to keep the basics covered. No major policy announcements that can burden the next government can be presented in the interim budget. The Election Commission's Code of Conduct does not allow the interim budget to include any major scheme, as it could influence the voters. The ruling government cannot present the economic survey with the interim budget. Interim budget helps avoid any financial hiccups during the changeover. It's like a smooth handover of the current government's responsibilities to the new one, making sure the country's money matters keep going along until the new government can fully take charge and plan for the whole year ahead in the union budget. The parliament passes a vote on account through the interim budget. This is a provision that allows the government to obtain parliamentary approval for essential government spending, such as salaries and ongoing expenses. Though it sounds similar to an interim budget, there is a fundamental difference. while an interim budget is similar to a full budget but only has projections for a few months as opposed to a full financial year, a vote on account deals specifically with expenditure and can be passed by Parliament without a formal discussion. So vote on account is just an interim permission to spend money for a brief period.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
But in the 2019 interim budget, the government had announced tax SOPs. It had raised the tax exemption limit from 2,50,000 rupees per annum to 5 lakh rupees per annum. Well, that's all we have for you today. For more news and analysis, please log on to business-standard.com. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.